The banks needed $17 billion this morning, not to lend, not to invest, to survive. $17,251 million. That is the exact number that just came out of the Federal Reserve Bank of New York on Friday, December 26th, the day after Christmas, when the entire world was supposed to be sleeping. This is not a routine transaction. This is not year-end window dressing. This is a confession. And today on Financial Joe Alert, we are going to break down exactly what this confession means, because the evidence now proves that JP Morgan and the Bullion banks are mathematically trapped inside the largest silver short position in history, and the trap is closing. Let me show you the evidence, piece by piece. First, you need to understand what the Federal Reserve repo window actually is, because this is not where healthy banks go to borrow money. The repo facility is the emergency room of the global banking system. It is the pawn shop of last resort. If your balance sheet is healthy, you borrow from other banks, you trade in the interbank market. You do not knock on the Fed's door at 8 in the morning with your hands out. Going to the repo window is the walk of shame of the financial world. It is a public signal that no other institution will lend to you, that your collateral is suspect, that your books cannot be trusted. So here's the question that nobody in the mainstream media is asking. Why would the masters of the global economy, the too-big-to-fail institutions that supposedly control everything, need $17 billion in emergency cash on the quietest morning of the year? The answer is one word: silver. Now connect the dots. Look at the timing carefully. Yesterday, silver gapped up overnight. It moved past $77, and the bullion banks were sitting on short positions worth hundreds of millions of ounces. They sold those contracts at $30. They sold more at $50. They sold even more at $70, because they always believed they could crush the price like they have done for 40 years. Trigger the stop losses, spook the retail investors, buy it back cheaper, pocket the profit. But this time something different happened. The retail investors did not sell. The Chinese industrial buyers did not sell. The vaults were already draining, and the price did not go down. It went vertical. If you have been watching this channel and you understand why that matters, you are already ahead of 99% of people in the financial world. Stay with me, because the math I am about to show you is going to change how you see the entire system. Now let me show you exactly how much blood they are losing. One single silver futures contract controls 5,000 ounces of silver. A major bullion bank might be short 10,000 contracts. That is actually a conservative estimate. 10,000 contracts multiplied by 5,000 ounces equals 50 million ounces of exposure. Now, every single dollar that silver rises costs that bank $50 million in losses. Silver did not rise $1. Silver rose $5 in a single overnight session. That is $250 million gone before they could finish their morning coffee. And that is just one bank. Now multiply that number across the 4 major United States bullion banks and the 4 large international ones. We are talking about billions of dollars in losses, accumulating every single hour that silver stays above $77, tick by tick. Now here is the detail that proves this was not accidental, this was not routine, this was desperate. Friday, December 26th, the single quietest trading day of the entire calendar year. Volume is minimal, attention is zero. The world is still eating Christmas leftovers. In the banking world, bad news is always buried on a Friday. Banks fail on Fridays. Regulators seize assets on Fridays. Emergency interventions happen on Fridays, because by the time Monday morning arrives, they hope you have forgotten. They chose this exact moment because they were praying nobody would be watching. They needed $17 billion, and they were hoping it would slip through the data completely unnoticed. We noticed, and here is the line that explains everything. They did not go to the Fed for a loan. They went to the Fed for a tourniquet. And when you need a tourniquet, you are not investing. You are bleeding out. But here's where it gets truly terrifying, and this is the layer that the mainstream media will never explain to you. The Federal Reserve can print $17 billion before lunch. They can print 17 trillion if they choose to. Money is not the problem. The problem is the metal. This morning the COMEX released the December delivery report. 12,707 contracts are standing for physical delivery. One contract equals 5,000 ounces. That means 63,500,000 ounces of physical silver are being demanded right now, in a single month, from a single exchange, during a holiday week. That is roughly 8% of the entire annual global mining supply, demanded in 30 days. Now look at the registered vaults. The metal that is actually available to deliver against these contracts. That inventory has been bleeding dry for months. The numbers are near historic lows. The demand is 63 million ounces. The supply is essentially zero. So think about this very carefully. The Fed solved the cash problem. They wired $17 billion and the banks can stay open another day. But the people holding those delivery contracts do not want dollars. They saw what happened in Venezuela, they watched the Shanghai premium, they do not want a settlement check, they want the silver. And the Fed cannot wire silver. It is not a number on a computer screen, it is a physical element, atomic number 47. You cannot create it with a keyboard. The Fed solved the wrong crisis. The crisis that matters cannot be solved by printing. If you know someone who still believes the banking system has everything under control, send them this video right now. Because what I am about to tell you next is something they need to hear before it is too late. And now here is the trap, the mathematical cage they have locked themselves inside. Why did the banks need emergency cash this morning? Because silver rose and their short positions are drowning. What did the Federal Reserve do? They printed $17 billion and handed it over. What does printing dollars actually do? It devalues the currency. What happens when the currency loses value? Hard assets rise in price. What is the hardest, most constrained physical asset on the planet right now? Silver. So the very medicine they use to treat the problem makes the problem worse. Every dollar they print to save the banks pushes silver higher. Every dollar silver rises requires a bigger injection next time. They cannot stop printing because the system collapses. They cannot keep printing because the currency collapses. This is a self-defeating loop. They are trying to put out a fire with gasoline, and here is the dark humor of it all. The more aggressively they fight the price of silver, the faster the price of silver rises. The banks have accidentally become the most bullish force in the silver market. They are trapped. The mathematics do not care about their balance sheets. The mathematics do not care about their political connections. The trap is real, and it is closing. If you want to know the exact moment when the next leg of this move begins, subscribe to this channel right now and turn on the notification bell. Because the signal I am tracking will appear before the mainstream media has any idea what is happening. Now let us talk about what happened in the short seller market today. Because this is where the final proof arrives. The cost to short silver through the SLV exchange traded fund collapsed today. It fell from 1.5% down to 0.6%. And at the same time, 10 million new shares of SLV became available for borrowing. The pundits on mainstream financial television immediately declared that the squeeze was over, that liquidity was returning, that the shorts were comfortable. They are wrong, completely wrong. A falling borrow fee does not mean the shorts are winning. A falling borrow fee means the shorts are gone. They are returning their borrowed shares. They are closing their positions. They ran the numbers. They saw the $17 billion repo spike. They saw the 63 million ounce delivery demand. And they decided that stepping in front of this market is financial suicide, so they walked away. This is not a sign of strength. This is the white flag. The short army has looked at the battlefield, calculated the losses, and retreated. And without sellers fighting the price at every dollar, without that constant downward pressure, who exactly is left to stop silver from rising? Nobody is left. The ceiling is gone. The dampening mechanism is broken, and the market is now running on pure physical fundamentals. And do you think Beijing did not see that $17 billion wire transfer? Do you think Moscow missed it? They are watching. They know what it means. The United States banking system needed emergency cash because a commodity price moved against them. That is not strength. That is exposure. And when you know your opponent is exposed, you do not ease up. You press harder. You increase your physical purchases. You tighten your supply chains. You make the pressure worse until the structure breaks. China understands that if silver stays above $80 for another week, the Federal Reserve will need to inject 50 billion more. At $90, maybe 100 billion. They can force the most powerful central bank in the world to destroy its own currency just to keep a handful of trading desks alive. This is not speculation. This is financial warfare. And the Federal Reserve just handed the other side a detailed map of every weakness in the American financial system. Now let me say what needs to be said. To every person who bought silver when the entire financial establishment told them it was a pet rock. To every individual who held through the manipulation, through the price smashes, through the years of ridicule from people in expensive suits on television. To every person who understood what the system refused to acknowledge. You were right. You held the line while they leveraged themselves into a position they cannot survive. You held physical metal while they held paper promises. And now the receipt has arrived. $17 billion of Federal Reserve emergency cash is the receipt. It is the proof that they are terrified of what you are holding. The banks are insolvent on a mark-to-market basis. The Federal Reserve is trapped in its own loop. The vaults are empty. The short sellers have surrendered. And the only thing holding the price of silver below $100 is a printing press that makes the problem worse every time they use it. $100 is not a prediction. It is a mathematical consequence. The equation was written this morning at 8 o'clock in the Federal Reserve Bank of New York. Now the skeptics will say this is fear-mongering. They will say the banks always survive. They always find a way. And historically they are right. The The banks have survived every crisis since 1987 because historically the Federal Reserve could print money without triggering immediate physical consequences. But this time the consequence is already visible. It is called $77 silver. It is called 63 million ounces of delivery demand. It is called a world full of buyers who no longer want paper when the paper is being debased to save the paper sellers. History does not repeat exactly, but it rhymes. The London gold pool tried to hold the gold price artificially low in the 1960s. It collapsed in 1968 when the physical demand drained the vaults. We are watching the same mechanism in silver in 2026. The outcome will be the same. Physical reality always wins. The game has changed, the rules have changed, and the price is about to reflect the new reality. This content is for educational and informational purposes only. It is not financial advice. Always conduct your own research before making any investment decisions. But if you have been watching this situation develop, if you understand the evidence we walk through today, you are not a passive observer. You are someone who sees what is coming before it arrives. In my next video, I am going to break down 3 specific indicators that will tell us exactly when the COMEX is approaching a physical delivery default, the registered inventory drain rate, the delivery to open interest ratio, and the warrant cancellation pattern. When those 3 indicators align, the paper price and the physical price will separate permanently. That is the moment everything changes. Subscribe to Financial Joe Alert, hit the notification bell, and I will see you in that video before the rest of the world understands what is happening. The silver squeeze has only just begun.